Recessions have always been followed by recovery that includes a strong rebound in the stock market. When the economy may be headed into a downturn, it's a good time to review how to take advantage of the recession instead of letting it take advantage of you. The first thing that you can do is seek out core sector stocks. During a recession, you might be inclined to give up on stocks, but experts say it's best not to flee equities completely. When the rest of the economy is on shaky ground, there are often a handful of sectors that continue to forge ahead and provide investors with steady returns. Even during recessions, consumers need to buy food, drugs, hygiene products, and medical supplies. These are consumer staples that are the last items to be cut from the family budget. So while companies selling high-end electronics and other products experience drops in revenue, companies selling food products and other basic necessities do not. Because of this, companies in the consumer staple sector are sometimes called defensive stocks, since they tend to remain resilient even when the economy falters. So if you want to insulate yourself during a recession partly with stocks, consider investing in the healthcare, utilities, and consumer goods sectors. People are still going to spend money on medical care, household items, electricity, and food, regardless of the state of the economy. As a result, these stocks tend to do well during busts. Two is buy into dividends. If you are going to hold stocks during a recessionary period, the best ones to own are from established, large cap companies with strong balance sheets and cash flows. Not only are these companies better situated to weather economic downturns than smaller companies with poor cash flows, but they are also more likely to pay dividends. For investors, dividends serve a few purposes. First, if a company has a long history of paying and increasing dividends, you can have peace of mind that is financially sound and can survive most economic environments. Second, dividends provide a return cushion. Even as share prices decline, you still receive a return on your investment. It is for these reasons that dividend stocks tend to outperform non-dividend stocks during market downturns. The best way to own dividend stocks is through mutual funds or EFTs that invest strictly in dividend paying companies. Funds that invest in companies with long histories of paying dividends and strong track records of increasing those dividends tend to generate high current yields and capital appreciation when the stock rebounds. That is, consider buying real estate. The 2008 housing market collapse was a nightmare for homeowners. However, it turned out to be a boom for some real estate investors. When a recession hits and home values drop, it might be a buying opportunity for investment properties. If you can rent out a property to a reliable tenant, you'll have a steady stream of income while you ride out the recession. Once real estate values start to rise again, you can sell at a profit. 4 is purchase precious metal investments. Precious metals like gold or silver tend to perform well during market slowdowns. But since the demand for these kinds of commodities often increases during recessions, their prices usually go up too. You can invest in precious metals in a few different ways. The most straightforward route is buying coins or bars from a seller or coin dealer. But this is different than buying a security, is technically as good as any other option. If you are more interested in buying precious metal securities, turn your attention to EFTs. These funds are collections of investments within a single industry, which, in this case, is the precious metal market. You could also purchase a gold IRA if you are saving specifically for retirement. 5 is use the dollar cost average when share prices decline. As with most recessions, you probably will not see the next one coming, but will likely see a sell off in the stock market well in advance of a recession. When that happens, remember the first lesson. The stock market will usually begin to bottom well before the end of the recession. Knowing that investors can take advantage of a declining market through the dollar cost averaging method of investing. If you make monthly contributions to a qualified retirement plan, you're already using the technique. But when the market starts to plunge, it is time to take advantage by increasing your contributions or starting dollar cost averaging in a non-qualified investment account. There are a lot of lessons to be learned for investors. The first lesson of a recession is that it is always followed by recovery that includes a strong rebound in the stock market. The second lesson is that investors do not have to sit idle as their portfolios get crushed by massive selling. There are some investment strategies that can take advantage of recessionary forces to position a portfolio for a quick and strong rebound. Take advantage of a recession period and profit from it. Please subscribe and I'll see you in the next video. Thank you for watching.